Yeah, thank you, Scott. That was fantastic. Let me tell you a little bit about Lamond Woods. Lamond has over 25 years of experience as an insurance provider and risk transfer specialist. He's a senior partner at Century West Insurance Services, specializes in risk management for community associations. As a member of the Community Association Institute Legislative Action Committee, Lamond worked directly with the drafters and legislators on the language for SB 167, the bill that recently became law. Well, actually, it's been a while now, and dramatically improved the insurance scheme for community associations in Utah. He spent years educating community managers, attorneys, and community association volunteer leaders about insurance and risk management. And I'll just chime in there. So when HOA attorneys have questions about insurance issues, they call Lamond. I do. And he's fantastic. He has always sought out and implemented innovative ideas to more efficiently and economically provide insurance to his clients. More recently, he's devoted considerable time educating attorneys and community association managers on the insurance laws applicable to community associations. He continues to work diligently on new laws impacting community associations and especially those involving insurance issues. Lamond has previously served as a board member for QCOM International. At the time, QCOM was a publicly traded telecommunications company. He has also served as a board member for Resort Condominium in Park City, Utah, which I'm sure was always fun. All right, Lamond, take it away.
Thank you. I definitely need to update that bio a bit, but it's a pleasure to be here with you today. I'm going to go ahead and try to get my screen up. And hopefully you are seeing my presentation. So my name again is Lamond Woods. I'm with Century West Insurance and have been primarily helping community associations in my practice for the better part of two decades. I was honored to be part of the committee. Bruce Jenkins, who we've already heard from, was the primary drafter on the legislation. At the time, it was SB 167. It's certainly not new. In fact, that legislation passed in 2014. It was passed in 2011. It was updated in 2014 to address a couple of issues that we'll talk about today. But I believe that our state statute is model legislation. There are a few other states, probably a handful, that have similar legislation affecting insurance. My remarks primarily and what I've prepared have to do with attached products. So think townhomes, condominiums. We're not going to talk about any of the liability provisions. There are some liability provisions for single family PUDs, but what the law addresses primarily is property insurance for attached communities. As I stated earlier, there are two sections. 57.8 43 is the Condominium Act for insurance, whereas 57.8A, these sections 401 through 407 of the Community Association Act either directly address insurance or are applicable to insurance. I'll give you just a little background about the legislation and why it was necessary. And why we addressed that, a decade ago. Prior to the passage of the legislation, there was virtually no language whatsoever in the Community Association Act regarding insurance. Whereas with the Condominium Act, we had this information here. In fact, I regret not having a little better copy of this, but this was all that it said pertaining to insurance for condominiums. And it was vague, ambiguous, because it relied so much on the CC&Rs. So we'll talk about that as well. But so this, a couple examples. of this is that, there was a situation where, and this is actually in the material, where a claims adjuster decided that rather than pay a claim under the unit owner's policy, under what's referred to as the HO6, that they were going to rely on the master policy to cover the damage to their unit. That claim prevailed, and the association's insurance ended up paying for that damage. I don't remember the details because it was a long time ago, but that was one way that the adjusters and insurance companies could utilize, almost weaponize our law in their favor. There's other situations, though, where it was used the opposite. In fact, I have a situation where the unit owner didn't have insurance, and the board and management made a strong appeal to have coverage for this claim. And when I'm talking about these claims, think about the interior of your unit of a home, not the exterior. On a condominium, the exterior was always and still remains the association's responsibility to provide insurance for that. So if you have wind, hail, things like that that damage the roof, that's going to be, and has always been, the master policy and the association's insurance that would take care of that. But inside the unit was a different story. So in the case that I started to describe, the unit owner had no insurance. The board and, again, management made a strong plea to try to get coverage for this situation. And we went ahead and used the language of the statute to compel the claims adjuster on the master policy to pay that. And it was paid. So again, the ambiguity gave uncertainty about how claims would be handled. We got to the point where we started using attorneys to draft resolutions to actually clarify what the intent of the insurance is. And the reason that was necessary was because, particularly with a townhome, something that was a non-condominium, there was just zero guidance whatsoever. And in the insurance policy, it has this language that I have highlighted here in yellow. So the insurance policy will cover these things. So again, what is covered? Any of the following types of property contained within a unit, regardless of ownership, if your condominium association agreement requires you to insure it. So that's the language that still is prevalent in other states for if they have not addressed this. So that is what allows us to cover those improvements and betterments that have been made to a unit. Let me look. So again, the ambiguity, the reliance on the CC&Rs, and then of course claims were a strong reason for why the law needed to pass or to come into effect. These photos that I have at the bottom is not something that should ever happen today. We have a fire that was occurring, and then a few months later, the individual unit had no insurance, and his neighbor or her neighbor was unable to get a certificate of occupancy to rebuild. So the next part of our discussion, I'm going to continue about the insuring agreements and go through that, and then we'll talk specifically about our statute. So within the insuring agreements, there are typically 3 different ways that we can handle that. They are either bare walls, a single entity, also known as original specifications, and then all-inclusive. Our statute requires all-inclusive coverage. So bare walls would be, the association's insurance would be responsible to put drywall in the unit, and that's it. No cabinetry, no floor coverings, nothing else. Single entity, that provision would put the unit back to the same condition it was when the unit was first conveyed, say, from the original declarant. So how it was, maybe think of the model unit and what was the furnishing or finishes that were conveyed at that time. And then all inclusive or all in is what an example we've been using for years is if you turn your home upside down, anything that is still attached in that scenario is what the insurance is responsible to cover. So think carpet, paint, drywall, cabinets, fixtures, improvements. We're going to cover those, whereas those things that fall, your personal property, your furnishings, your clothing, all of those things, those are and always will be your responsibility to provide insurance coverage for. I might add to that, the master policy has no obligation or insurable interest in liability coverage that happens inside your unit. So if someone's assaulted in your unit, if it's a rental and the old tenant has the key and assaults the new tenant, the association's insurance, if it's named in that, it'll defend itself, but there's no coverage directly for that, that injury inside a unit. Again, common area injuries, if someone was visiting and their neighbor from another property and they slipped and fell and called an attorney to represent them and they named the association and the unit owner, the association's insurance does have an obligation to defend not only the HOA in that case, but also the unit owner in that case. But in terms of extra loss of rent, things like that, if you're a landlord or if you have to stay somewhere else while your home is being rebuilt, again, the association's insurance is never going to have coverage for you. That's your own policy that needs to take care of those things. So property insurance. When the legislation passed, there was basically a grandfathering for community associations that stipulated that if their CC&Rs already required that the unit owners provide their own coverage, as in ensuring the entire structure, then they are grandfathered and can continue that kind of scheme in perpetuity. So that's something to be aware of. Not all insurance agents understand that. Property managers and maybe even some attorneys don't realize that there is that provision that allowed the grandfathering of those associations who already were requiring the unit owners to insure the entire structure. But any declaration that was recorded on or after January 1 of 2012 is now required to have blanket property coverage. So there is a condition for commercial condominiums. That legislation got updated in 2014. We hadn't thought through all of that in the 2011 draft. So if you're a commercial condominium and you don't want to be on the hook for these permanently installed equipment that maybe someone in the association owns, maybe think a dentist office where they have permanently installed equipment. Now the association's insurance is not going to be on the hook to have to replace those. Let's see, so coverage must start not later than when the first unit was conveyed. So think of a phasing community, a newly developed community. The insurance must take effect on that day or sometime sooner than the day that unit was first conveyed. The insurance policy requires certain coverages, and we'll talk about those. So blanket coverage and guaranteed replacement cost coverage. So blanket coverage is a term that is used that's opposed to a schedule. So if you have 10 buildings that are all each valued at $1 million, on a schedule, you have $1 million per building. Whereas with a blanket, you have all of those values added together, and you have now $10 million to use wherever you need it. Guaranteed replacement cost is in that same genre where you could still use a schedule, but with guaranteed replacement cost, you'd meet the provisions of the law because GRC is going to be that safety net that says, hey, if you only had $1 million for that unit, but it's going, or building, but it's going to cost $1.2 million to rebuild, then GRC gives that coverage. Not all companies offer GRC, but I consider it the gold standard when it is available. I'm going to pick up the pace just a little bit. The replacement cost, you must be insuring for the full replacement cost of the structures at each renewal. So with the increased cost of construction that is occurring, you're likely seeing, if you're living in one of these communities, a significant increase in the TIV, the total insured value. This paragraph is worth reading. It's directly from the law where it states about what the property insurance shall include. So it shall include coverage for any fixture, improvement, or betterment installed at any time to a unit or to a limited common area associated with a unit, whether installed in the original construction or in any remodel or later alteration, and then including floor coverings, cabinet lighting, fixtures, electrical fixtures, heating, plumbing, paint, wall coverings, and then this catch-all and any item permanently part of or fixed to a unit. One of our HOA attorneys used the example that if someone installed a golden toilet and that golden toilet was damaged in a covered event, covered loss, that the association's insurance would be on the hook to cover that, and that is correct. The association's insurance is primary coverage, which can be a problem, and we'll talk about that. Again, these are all bullet points directly from the law. Okay, what is the association's kind of obligations in this? Well, they must maintain property insurance. If you become aware that you're not able to get a renewal coverage or a renewal policy, then you must give your owners notice of that. If you have a provision in your CC&Rs that's contrary to the law, then the law trumps that provision. There is a requirement to set aside an amount equal to the policy deductible on that property coverage for the master policy. It must be $10,000, or if you have a $5,000 deductible, you only need $5,000 set aside. If you have a $10,000 deductible, you have to have 10,000. But if your deductible is 25 or 50,000, and those are becoming the new norm, I'd say 25,000 has been the standard through all of this year and part of even 2022. And we're seeing communities go to 50,000 with in a high percentage of situations. But you do not have to have $50,000 set aside. It is capped at 10,000. However, you do not want to take on a $50,000 deductible if the association has zero money or not sufficient money to cover that deductible, if it's the association who has to pay that deductible. You may think that a $50,000 deductible for a unit owner is a hardship. I would argue that if they have insurance, that $50,000 deductible is not a hardship. And why? Well, it's because unit owners can choose their own deductible. They can choose a $500 deductible on their HO6 policy. And then if a covered event happens, the out-of-pocket to them is no different if the deductible is $5,000 or $50,000, because again, their insurance will kick in at that amount. I argue all the time or state that a unit owner without insurance is a liability to you. And I have examples even that have occurred in the last few weeks of that exact scenario. So we want to motivate our unit owners to have that coverage. I don't necessarily recommend policing that, but we do want to incentivize them to have have the right coverage and adequate coverage. Um, uh, so within this provision of the deductible, you must give notice of that deductible amount. And if you change it at any time, you want to give them notification of that as well. Before I move on, just to end the other thought about hardships for your unit owners. If you believe that your insurance cost is going to dramatically increase from going from a $10,000 to a $50,000 deductible, I urge you to actually, look into that, because a majority of the time that's going to be in the $20, $30 range per year for that. So again, I do not believe that these higher deductibles are a hardship to the unit owners. So again, you have to give notice to them, and if you fail to give notice as an association, there's ramifications there that the association could be on the hook for the difference between what the unit owner knew was the deductible and what it became. What is the unit owner's responsibility? Well, I think that's one of the great things about the law, is that we now have clarity in what the unit owner needs to insure for. So the unit owner simply needs to know what is the deductible on the master policy. And as a rule, for some time now, we've always said that you ought to have $25,000 of coverage A. And coverage A is the portion of the HO6 policy that covers that deductible. So if the association had a $5,000 deductible, we would still issue $25,000 of coverage, not because it was necessarily critical, but because it was so cheap. In some cases, it was, less than $10 a year to bump that up to a higher amount. And I have said that there are certain situations where the unit owner policy may be more generous in what it covers than the master policy. To a large degree, we're seeing just the opposite of that. I've said that if you have a named peril HO6 policy, you're missing out on critical coverage. So always ask for a special form policy, special form versus named peril. Anyway, but that's the unit owner's responsibility, is to cover that deductible. So we get into claims. Notice that a covered loss, what you own, what you insure, and what you maintain in a community association can all be different. What you own, what you maintain, what you insure can all be different. So a covered loss is a loss that is covered by the insurance company. If it's not covered, then that's going to fall back on the maintenance responsibilities within your CC&Rs. If it's in your unit, that's almost certainly just you as an owner. The unit owner's policy is considered primary until such time as the claim is deemed, or the damage and repair is deemed to exceed the deductible, at which time then the master policy takes over. Let's see. Yeah, the association is responsible for the common area. I've said common elements. I'm just trying to say common area now. So previously, a common element to me would be the roofs, something that everyone owns in common. But I understand that just saying common area will also catch all of those things. So think a clubhouse, your roofs, again, things that are you're responsible for. There is the business judgment rule has been talked about, and again, in the business judgment rule, if the committee determines that a claim is not likely to exceed the deductible, then the unit owner is responsible for that until such time as it becomes obvious that it is over that amount. If multiple units are affected in the same claim, then there's a protocol for that. It's this loss damage percentage. Basically, if there's 2 units involved and the total for each, for both units combined is $100,000, and my unit suffered 60,000, and my neighbor suffered 40,000, then I'm 60% on the hook for that deductible, and my neighbor is 40% on the hook. I believe that the legislation is now proven that it was worthwhile and effective. Certainly, it has eliminated duplication of insurance coverage where you're just paying more to the insurance company for coverage. Back in the day, an owner had was a heating pad that they left in their microwave. They left it in for an hour instead of a minute and headed off to the store, came back to severe damage. That unit owner tried to make a claim under their own policy, and the policy said, well, yeah, we'll gladly pay it. We have sufficient coverage, but we think that the association is primary on that. And the association's insurance took care of that for them. So again, duplication of coverage has been eliminated. It's now you just need to know the deductible. Certainly the claims process has become much easier. We no longer have to rely on the CC&Rs to determine what is and isn't covered inside a unit. And then just the last thing is that deductible can become an effective risk management tool. So we've gone over a bit there. So Jeremy, I'll turn it back to you.